Good evening, ladies and gentlemen, and welcome to our class brought to you tonight by Invest Markets. And tonight we're going to be learning about how to read and use your financial charts. Now, when you trade with Invest Markets, you can trade with confidence. You can discover our advanced and innovative intuitive web trading platform and trade CFDs with confidence in the most popular and sought after worldwide assets. You can trade Forex, commodities, currencies, cryptocurrencies, indices, and shares. Plus, when you join us at Invest Markets, you get access to the world-renowned service provider Trading Central. You get their all-new Buzz, which is a artificial intelligence which pulls together all the information and all the news and all the headlines from around the globe. So you're not spending your time searching the internet to get out-of-date articles, to get out-of-date stuff, tired old stuff, and spending your time getting misinformation. You also get up-to-the-minute analysis views of the markets. You get daily market analysis broken down on all the major sectors. You get our economic insights. You get our featured ideas. You get our strategy newsletter. You get the market buzz. You get our research platform, and you get web TV. All of that as a trader with Invest Markets. So whether you want to trade stocks or CFDs on the global markets, whatever you want to trade, you'll find it available on the Invest Markets platform. Now, Invest Markets is a regulated provider, so I am therefore required to give you a risk warning. So I'm going to read the first sentence, and I would appreciate it if you could read what's on your screen under the risk warning here. Contracts for difference, or CFDs, are complex financial products with speculative character, the trading of which involves significant risk of loss of capital. Trading CFDs, which is a marginal product, may result in the loss of your entire balance. Remember that leverage in CFDs can work both for you and against you. CFD traders do not own and do not have any rights to the underlying assets. Trading CFDs may not be appropriate for all investors. So now that we've made the regulators happy, let's get on discussing price charts. Now, it's no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with charts. So whether you want to be a fundamentalist, a technical analyst, whether you want to use quantitative analysis, there's many methods used by traders to predict price movements of currency pairs. Some traders focus on news, interest rates, and economic variables, while others prefer to use charting tools and indicators to guide their trading. However, no matter your trading method, you'll need to know how to read a chart. There's no escaping it. But you must crawl before you can walk. Now, no matter how you want to trade, no matter what your own thing is, you decide. I'm not going to tell you how to trade. I'm not going to tell you what strategy to use, what analysis to use. But if I say to you the euro is trading at 117.42, and when it was trading open this morning at 117.49, and then it dropped down to 114.74, and then went up to 117.82, and then an hour ago it was at 117.94, and then it peaked up to 118.47, and then it came back down to 117.92. Could you repeat any of that to me? And that was only 8 different prices. Could you make any heads or tails out of what I just said? Nope. Our brains just cannot absorb that material and put it into a easy to understand format. So this is one of the places where that old adage, a picture is worth 1,000 words, comes into play. Because no matter how you're trading, no matter if your buddy Jack has inside information and is never wrong, and you do whatever he says blindly, you're still going to need a chart to see what the price is and to see where to enter the market. Because he might tell you he's got secret information that X, Y, and Z stock is going to jump up this afternoon by 10 points. Okay, so you want to trade X, Y, and Z, but you don't even know what X, Y, and Z is trading at. So when you call your broker or you go online, you got to decide what price you want to enter the market, because maybe X, Y, and Z already went up to 10 points before you got on there. So no matter how you're going to trade, you have to use a chart just to give you some way to interpret what those numbers are trying to tell you. So a price chart is simply a graphical depiction of the current and historical price of an asset. Now, there are different types of charts that we use in trading. Some are more complicated or less complicated than others. The most basic is a line chart. A line chart is a good way to simplify the displaying of price, but we can't use it for any of your trading. A line chart simply puts a dot on the chart at every time period at the close. Let's go over to a live chart, because we're going to look at the exact same thing here. But let me take you over to a live chart. Hold on a second. Okay, so we're looking at the Euro US dollar 1 hour chart. And I'm going to make it a line chart. Now, fortunately, in today's markets and with today's advanced Java and HTML charts, we can flip from one type of chart to the next, to the next, to the next without doing anything. But the fact is, a line chart, and even though tonight I'm going to tell you there are 3 basic charts, there's all types of variation. Even in a simple little line chart, we have an area chart, which is simply a line chart with one of the sides colored in. But we're looking at the Euro US dollar 1 hour chart. What that means is we're going to put a dot on the chart at every 1 hour, at 1 hour intervals. Now, when I started trading 100 years ago, it was almost that long ago, in the 1970s, we didn't have computerized charts. We didn't have computers. We didn't have the internet. So we would sit there in a hand chart. And we didn't have the choices we have today, because now today we have these developers who are developing all these advanced charts. But these computer developers, even though most of them are geniuses, don't know the financial markets. So somebody along the way got too cute and said, now we could have a line chart that uses hold on a second. The open, the high, the low, the close as well. Oh, line chart. Okay. Gives us today the choice of open, high, low, close. We use high, low divided by 2. We can use the high, low, close divided by 3. We can use the open, the high, the low, and the close divided by 4. Well, it's all a bunch of malarkey. It's been the close, always been the close. But today, there's all kinds of gurus out there telling you everything. The fact is, it doesn't make much of a difference. It doesn't change it, especially in a line chart. So let's stick with the standard that's been used for years. And so at the end of each period, we put a dot on the chart at the close, and then we connect those dots together and gives us a line chart. It is the most simple type of chart we have, the most basic chart, and it doesn't give us much information. I don't ever look at a line chart, ever, because it doesn't give me anything. It just gives me a general movement of price. Nothing I can even make an understanding of or make a market decision or understand what the asset is doing. Now from here, we go to what's known as the bar chart. Bar chart was the most popular chart around. And up until we got, even when we had the internet and we had the beginnings of computerized charting, when we didn't have the choices that we do today and all the advanced technology we do in charts, not in trading, and just in charts, everybody used bar charts. Now, when I started trading, again, this is a chart everybody used, because we would sit in the pits with graph paper and our pencils, and we would draw the bar on the chart in each period. So this is, again, the €1 US dollar 1 hour. And each one of these bars covers 1 hour of trading. So at the beginning of the trading session, whatever price the open was, we would put a line, a dash across. At the close of the trading session, we would put a dash across. At the highest price that the asset went to, we would put a dot. And the lowest price, we would put a dot. And we would draw a line connecting these. This gives us the bar. Now, if we stepped up the ladder from the open to the close, that would have been a bullish session. If we stepped down the ladder, so in other words, the market opened here, because that's always the dash to your left, and closed here, so we stepped down the ladder, that would have been a bearish session. So as you can see on this chart, we have bearish sessions and bullish sessions. We have big opens and closes, and we have different types of bars. And in those days, the bars were always black because we were using a pencil, and we would use the pencil to draw this on our chart. And we were hand charting, so we didn't have much time. We were very busy because you're following 10 assets. And you got to keep all the charts up to date for 10 assets. That's a lot of charting. Again, today's developers went a bit too far, and they've given us all these choices with bars, and now we can make them reds and greens just like candlesticks. Hurts my eyes, but a lot of bar charts come just like this, and they try to apply the same interpretations that we had for candlesticks. Because again, it's developers giving us too many choices, and then all of these untrained market gurus that come along and want to teach you their system. And they all have something they want to, that they say is unique, or they want to show you. Now, this is a bar chart. The most popular chart for online trading, and the third class of charts, because again, with bar charts, we have other types of similar charts. But the most popular chart type for online trading is the candlestick chart. Now, if you notice, we went through 3 charts. Okay, I haven't changed anything. It's all the euro US dollar, all the 1 hour chart. But look at the difference in perspective. We have a price when we're looking at a 1 hour bar chart, a line chart. Then we're looking at a bar chart. And then we're looking at a candlestick chart. Well, candlesticks are very popular because a lot of traders think they get a lot of information by seeing these reds and the greens. Well, the fact is, green tells you you had a bullish session, red tells you you had a bearish session. But again, with my developers, I can use blue and purple. As long as I know which color represents bullish and which color represents bearish, doesn't make a difference one way or another. Now, we can see right here, I reversed my colors because look at these candles go down and they're green. because we have to know which is bullish and which is bearish. So a bearish session is always marked in red. A bullish session is always marked in green. So a candlestick. Now also keep in mind, you only have a limited set of variables. What do you have to build a chart? The open, the high, the low, and the close. And they're historic prices. They are prices that are open to interpretation. So for a candlestick, we put a dash across at the open. I'm sorry, a line across the open. We put a line across the close. We put a dot at the highest point and a dot at the lowest point. Well, it sounds exactly like we did with a bar, doesn't it? Except now what we do is we draw the lines just connecting the open and the close, and we draw a line connecting the high to the candle and a low to the candle. These are called wicks or shadows, and this is called the body of the candle. Now, if it was a bullish session, in other words, we went up from the open to the close, we had a bullish session. In today's world, we would make this green. We would color it the side of our pencil and make it a green candle. If it was a bearish session, we would make it red. And we would color it in with the side of our pencil. Now, the reason I'm telling you, well, you need to know the reds and the greens and the bullish and the bearish. But the reason I'm pointing out is back in the old days when I would sit there and we would hand chart, we would do the same steps. Draw a line across the open, a line across the close, put a dot at the high, a dot at the low, and connect them together. Now, this was pre-magic markers. It was pre-computers. It was I don't even know if we had big colored pens back then. We had crayons, but nobody carried around crayons. They were too big and heavy. We had our binder with our graph paper, and we had our pencils. And believe me, we had a pencil sharpener and a ton of sharpened pencils. You know, we looked like those nerds you see on TVs with the little pocket protectors with all of our pencils in there, because you're charting so much and so fast that you have to be really quick and easy, and you need fine lines. And so you would go through a lot of pencils. Now, the reason this was important, and the only reason it's important today, is when we would get a candle that was bullish, which today we make in green, we would just leave it empty. When we would get a candle that was bearish, we would use the side of our pencil and fill it in. So this would be a black candle, and this was a white candle. The reason I'm telling you this is because over the years, a lot of candlestick patterns and a lot of candlestick interpretation, because candlesticks are very, very old. I mean, they've been using candlesticks since I think the 1700s. Okay. So a lot of methodology you'll read about and a lot of patterns you'll read about will be called like 3 white crows, 3 black soldiers. Okay, because these were from the black and white days or the pencil days. Today, we didn't change the names to 3 green soldiers or 3 black crows, 3 red crows. It's the old names. So a lot of times when you see the candle referred to as a black candle or white candle, you understand what it means. White candle's a bullish candle, black candle's a bearish, and those patterns. Okay. Now, we're going to spend a lot of time on candles since they are so popular. We see on this chart probably an even amount of reds and greens. We also see long candles and short candles. Candles are very little about the amount of reds and greens you see. And this is where novice traders fall into traps, because they think when they see lots of red, and sometimes there's not even a lot of red, it's just more noticeable, that means sell or it's going down. And a lot of times when they see lots of green, it means to buy or it's going up. Well, sure, if you had 3 green candles next to each other and big jumps up, yeah, things went up, but it doesn't mean we're moving into an uptrend. Here you had 3 big green candles, but then we just moved into sideways action. Now, candlesticks are about a couple things. It's about the shape and the size of the candle and the body of the candle and the wicks. A very long candle tells you the market was very volatile and very active. A very short candle tells you have market indecision, because what happens, what do you have when you have a very short candle here? See the body of the candle? Not the wicks. The wicks are very long. Tells you something else. But the body of the candle, is the open and the close were virtually the same. Tells you there's lots of market indecision. So the size of the candles and also the length of the wicks are very, very important, not the amount of green or red you see. Now, in this case, the telltale candle wasn't any of this green. It was this red candle right here. Okay. But we're not here tonight to learn about strategies and interpretations. We're here tonight to learn about charts. But this is very important because candlesticks are the most popular type of chart, and they tell you a lot. Now, there is candlestick pattern recognition. That means when you hear about 3 white crows, or you see 3 white soldiers, or 3 red crows, or an evening star, a morning star, a hammer, you're supposed to read it, interpret it, and do this or do that. Okay. Well, it doesn't really work that way. Okay. Pattern recognition works in a very slow moving market with much longer term candles. Today, we can even have our charts tell us when these patterns come up. See, I just told my charts to tell me when I see a bearish engulfing and a bullish engulfing pattern. My charts find it for me, tells me what it means. But you know what? I don't need to be a trader. If I'm going to trade and sell or buy at a bullish or bearish engulfing, I don't need a chart. I can just get a robot to tell me that. But this is pattern recognition. If a computer can recognize it, you sure don't need to trade it. It's an important pattern when it appears, bullish or bearish engulfing, because it does tell us something. But memorizing this pattern and doing what the pattern tells you, okay, is wrong. Recognizing the pattern and then interpreting it is a whole different story. But that's pattern recognition and not charting. Now, the reason we use charts, whether they're line charts, bar charts, or candlestick charts, is the beginning part of getting the price in a graphic formation, so our brains can see that price and interpret it. There's also other things we have to know about charts, because you see, we're looking at the Euro US dollar 1 hour chart. All of these prices never change. Okay, the price that it was at 1400 on September the 1st is always going to be that price, no matter what chart you're looking at, no matter who you're trading with, no matter what you're doing. But if we change this from a 1 hour chart to a 30-minute chart, we see a whole different scenario in price. Let's just look. Okay. Right now, this is a live chart. So right now we have 3 green candles after a red candle, 3 other green candles. Means we have a very strong moving up price pattern. But we just got what's known as a doji, which is showing us market indecision, which means, okay, we saw this run up of price, but maybe the market's saying it's now run up too high. The buyers aren't sure what to do anymore. It's a nice run in price. But if we were to break it down into smaller segments, we could see a little bit more information. Because now we can see we have a very nice run up in price, and we have a very, very strong uptrend in prices continuing up, because this candle and this candle are equal to the candle we saw in the 1 hour. But now we saw that the first half hour of this last hour, price moved up very, very strongly to this highest point. When it reached the high of the previous candle, here is where it slowed down. Okay, so it slowed down in the last 30 minutes, but it slowed down at a point, the highest point. Okay, again, now we're talking strategy, but what we saw is we saw more detail by breaking down the 2 time periods. Because again, we go back to a 1 hour chart and we don't see as much detail. We just see in the last hour, it made no move at all. Now, if we were to go back in a longer period, we see more detail. So we see in the longer period of trading, we can see the euro US dollar. The euro has had a lot of momentum, and we are in a very nicely developed uptrend pattern. Push, ease, push, ease, push, ease. An uptrend is defined by higher highs and higher lows. And the more well-defined that uptrend is, the more secure that trading in the direction of that trend is. So here we see a very nice developed uptrend. When we go back to the 1 hour chart, we see an uptrend, but now we go back and we see it only back to the 27. And even though it's price is moving up, we don't see that qualified uptrend. We see more detail in there. We see prices moving up, but it's not as well developed. It's a little bit more erratic. So the 4 hour gave us a much better view of what this asset is going to do, and we know where the support for the asset is. We know that the buyers are pushing this price up steadily, and they push it up to a new higher high. They ease back down and then build the momentum again, and they push up, and it's making a very divine. When we break it down to a 1 hour chart, or break it down to a 30-minute chart, well, again, we see that, but now we're only seeing that move from 6 o'clock this evening. Now we see a very big push here, and then what we see is really some sideways action, a dip. Okay. Now, if you think of a longer term chart as a more environmental type chart, a shorter period time chart as an information type chart, and the smallest period as your trading chart. Okay. You can look at it, but you get a better understanding of what the asset is doing by using time frames. And whether you're trading on a bar chart, a candlestick chart, or looking at a line chart, the same holds true. Here's the line chart in a 30-minute, and here's the line chart in a 4 hour. Okay, if we look at the bar chart, four hour, 1 hour. Now, the other nice thing about our charts in our charting system, okay, because remember, tonight's class is about charts, is personally, I use my bar charts to put things on my charts like support and resistance lines. See these gold lines? They are my support and resistance line. To find and define an uptrend and put an uptrend on my chart correctly, because I can see price more clearly without the colors. This is me personally, because I just did this, and when I click on here to my candlestick chart, the line doesn't move, but I saw it more clearly with my bar chart. You could also put longer term trend lines by drawing them on your chart in the longer chart period. And then we can see the long-term trend, and we can see this is a very valid trend line. Okay. So we have a long-term trend line, and then we have a short-term trend line. Okay. It gives us more information about price, and what we're constantly looking for is information about price. So a chart serves many purposes. It first gives us our graphic depiction. It gives us a way to just understand 117.32, 117.44, 117.52, 17. It also allows us to see on our price chart the movement, the momentum, the speed in which an asset is moving, and then it lets us draw a conclusion. Even if you're not going to do any type of technical analysis, if you're just going to look at a basic chart with no lines on it, just so that you can see price, because when you're looking for an entry point or an exit point, or you want to know if your friend told you XYZ is going to go up 10 points and you went in to trade XYZ, how do you decide what price you're going to enter? And then when it's gone up to 10 points, how do you see it so that you can tell go on the computer and close out your trade? So let's go back to my PowerPoint. So again, we've talked about how to draw the candlesticks on your chart, what they mean. So before you can read a candlestick on a chart, you had to understand the basis of each candle. We talked about time periods. We talked about the black and white candles. We talked about the difference between a bar chart and a candlestick chart. Now, one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can be useful, even if it's not your primary method of trading. Now, let's take this term technical analysis, which freaks out lots of traders, and throw that word in the trash can, and let's call it chart analysis, because it's anything and everything we do on a chart. So whether we're putting a short-term trend line on a chart, whether we're just drawing a circle on our chart with our pencil, whether we're coloring in something, it's all technical analysis, because technical analysis is anything and everything we do on a chart. Technical analysis relies on the price that is on the chart you are using. Most charting systems will allow you to add technical analysis tools as overlays on your charts. Now, we talked about it, but you should always check the time frame being displayed, because many trading systems have multiple time frames, and you'll find that you can make a big mistake because you don't realize you're looking at a 4-hour chart. So make sure you select the time frame your chart. Now, there are other things that are very simple, like my lines across which are called support and resistance lines. Support and resistance lines and trend lines, and being able to read the price on charts, are 3 basic tools. They have nothing to do with really technical analysis, even though they fall in the field. But no trader should ever be looking at a chart and not being able to see the trend of the price and the next important price level. You need to know where, if I told you, again, with insider information, that X, Y, and Z was going to go up 10 points today, okay, and you run to buy X, Y, and Z. Well, you know X, Y, and Z was trading at 125, but you know in all of its history over the last year or two, it's never been able to push past 133. So that becomes a crucial level of resistance. Now, if I was going to buy at 125, and my buddy told me it's going to go up 10 points, I was saying, you know what? I don't think it will. I think it might hit 133. Or maybe my buddy I wanted me to buy at 120 to 130. But I know it's going to have a problem at 133. So if I'm in the market and I bought it at 133, I'm going to be sitting really close watching it because it's going to have a problem getting through there. But the only way we would know that is by looking back at historical chart prices on the chart to see where that asset's had problems getting high, moving higher when it's moving up or moving down lower. Like for instance, the euro has been as low as 105, 106 euro dollar, but not for a very long period. But 120 has been its average range over the last couple months. When it fell to 116, it offered a very nice buy scenario if you're going to buy it and sit on it, because we knew it was going to go up maybe to 117, 118, return to 120. It was a good buy. But in our short-term trading, if you bought it at 116.50, it might have gone down to 115.95 the next day. And because you're using leverage and margin, or you put your stop loss, you got stopped out. You have to be able to figure where you're going to, what your maximum risk is going to be, where you're going to tell the computer to close out your trade if the market moves against you. How do you know when the market, maybe your buddy was right, it was going to go up 10 points, but he told so many people that so many people bought it and now are ready to sell it that they're shorting the stock everywhere. And maybe you should have gotten out already because they're all shorting it, and it fell below 125. Not only did you not make the profit, you lost it all. So regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on the chart that will help you understand the markets. Okay. And you should be able to look at trends and trend lines, support and resistance levels, and use volume. You could actually make entire trading systems and make entire trades using those three basic pieces of information. And in our next classes, we have an entire class called The Trend is Your Friend. And we'll teach you about trends and trend lines. We have a class on support and resistance, and then we'll teach you how to build them together into a trading system so that you can make intelligent trades. So thank you very much for joining us tonight. Have a great trading week. And if you have any questions, just contact us here at Invest Markets. Bye now.